Okay, well, thank you. Welcome to the CFA Institute Research Challenge America's Regional Final. My name is Peter Watkins. I'm Senior Director for University Relations at CFA Institute. This regional final is the culmination of the competitions held in the Americas. Today we have the top 6 teams from around the region vying for their opportunity to be on that prestigious stage of the global final. The top 2 teams will advance to the global final, which will be held in person in Washington, DC on May the 3rd. Before we get started, I wanted to recognize and thank our sponsors for making the Research Challenge possible. Refinitiv is our official data services provider. Providing data access to the students has been a great educational benefit. I would also like to thank the societies across the region who were essential in getting us to today's competition. Without your support and partnership, none of this would be possible. I will now introduce the 6 teams competing today. California Polytechnic State University, representing CFA Society Sacramento and CFA Society San Francisco. California State University at Fullerton, representing CFA Society Los Angeles. Creighton University, representing CFA Society Nebraska. Universidad EAFIT, representing CFA Society Columbia. University of Tennessee at Chattanooga, representing CFA Society East Tennessee and CFA Society Nashville. University of Waterloo, representing CFA Society Ottawa and CFA Society Toronto. Congratulations to all of you for your significant success in reaching the regional final. You should feel very proud. The teams will be evaluated by an esteemed panel of judges, including Glenna Anderson, CFA, Gustavo Moreira, CFA, and Maura Murihi, CFA. Each team will have 10 minutes to present on their assigned subject company. Following the presentation, judges will have an additional 15 minutes to ask the team questions. Once all 6 teams present, the judges will break to deliberate. At this time, we will prepare for the first team to present, and we wish all 6 teams the best of luck.
Good afternoon. I'm Etanais, and with me are Samantha, Benjamin, Brendan, and Jimitesh. We're initiating coverage on AMD, a designer of CPUs, GPUs, and other semiconductors. Products are vital to powering the world's computing devices. We issue a sale recommendation with a target price of $86, representing a 10% downside from the April 10th closing price of $95. Strong cyclical headwinds, its weak economic moat, and geopolitical uncertainty support our sell recommendation.
The demand for semiconductors is driven by the dynamics of global computational device sales. Underlying our recommendation are 2 key characteristics of this industry. First, the demand for computer components is derived from the demand for computational devices. This means that AMD's economic success is ultimately sourced from the demand for computing end products. Second, PC lifespans have expanded to 8 years, leading consumers to replace their PCs less frequently. This means that today's PC sales will likely cannibalize future sales. Additionally, COVID resulted in a surge in PC demand, with analysts extrapolating this trend, leading to AMD's overvaluation. And despite collapsing PC sales in 2022, analysts are still optimistic, predicting a swift recovery in Q3 2023. But taking into account excessive COVID-induced PC purchases and expanding lifespans, our analysis indicates that demand will fall well short of recent analyst expectations.
AMD designs integrated circuits developed on the x86 architecture for a wide range of computing applications. Manufacturing is outsourced to TSMC and GlobalFoundries. The business consists of 4 key operating segments. The embedded segment services automotives, industrials, and IoT devices, with the $49 billion acquisition of Xilinx contributing to growing revenues in this space. The data center segment provides cloud solutions and data processing for companies like Microsoft, Google, and Meta. The client segment serves original equipment manufacturers like HP, Lenovo, and Dell, while the gaming segment powers graphics for PCs and gaming consoles.
The industry is comprised of foundries, which are pure play manufacturers, fabless design firms like AMD, and IDMs, which both design and manufacture products. And the industry primarily sources its revenue from 3 countries, the US, China, and Taiwan. Additionally, the primary catalyst for semiconductor growth will be AI, with TAM expected to grow at a 34% CAGR through 2025. The AI revolution requires significant computational power and speed, and while AMD does produce GPUs that are capable of parallel processing, the market leader NVIDIA is likely to dominate this space in the near future, placing AMD at a disadvantage in the crucial battle for AI market share in both the data center and embedded segments.
Headline inflation is trending downwards, and continued labor market strength has resulted in PPI growth and elevated services inflation. In response to persistent high inflation, central banks have been aggressively raising rates, bringing the Fed fund rate to 4.75%. Yield curve inversion, the deepest since 1981, suggests high probability of recession. Additionally, the current banking liquidity crisis has increased contagion risk, further tightening financial conditions. These factors put downward pressure on demand for computational devices and consequently semiconductor products.
There are 3 key drivers supporting our sell recommendation, with the first being cyclicality faced by AMD and the industry. COVID's work-from-home conditions created abnormally high demand for AMD's products, with year-over-year sales growth peaking at 68% by 2021. This spike in chip demand led to a rapid expansion in supply capacity, resulting in accumulating inventories and the erosion of pricing power. Industry cyclicality stems from the need for companies to continually introduce new product lines, requiring significant upfront investment. Additionally, computational devices are semi-durable goods. When a recession occurs, demand for these products suffers, adversely impacting downstream revenues. In anticipation of recession, memory, motherboard, and chip prices have been slashed in recent quarters, compressing margins industry-wide.
Second, intense competition from Intel and the encroachment of the ARM architecture significantly weakens AMD's economic moat. Intel and AMD are duopoly players in the x86 market, and their CPUs are perfect substitutes for one another, which makes consumers price sensitive due to minimal switching costs. Recently, AMD has been able to introduce competitive product lines, while Intel has struggled internally. However, we anticipate that AMD will not be able to outperform Intel over the long run. Intel still holds the majority of the x86 market and has a larger cash reserve, enabling it to outspend on R&D. Moreover, its strong financial position allows it to implement aggressive pricing strategies that may undercut AMD's. The ARM chip architecture also boasts greater power with higher energy efficiency, making it an increasingly viable alternative to x86 when it comes to PCs and data centers. Apple has already implemented ARM for all of its devices, with Amazon and Google following suit in their data center operations, further dampening the growth outlook for the x86 chip architecture.
Third, the China-Taiwan conflict presents a significant risk for AMD. Recently, tensions escalated as a result of increased U.S. military activity in Taiwan. Escalation of conflict could imperil TSMC fabrication. As a result, AMD's manufacturing costs could skyrocket, severely compressing margins. AMD derives 38% of its revenues from the Chinese and Taiwanese markets, and comprehensive sanctions could impair AMD's operations. Finally, supply chain fragility could drive customers away from fabless designers towards vertically integrated IDMs like Intel.
We developed our own econometric model to project AMD's revenue growth that accounts for our key drivers. The model links sales growth, dual PC unit shipments, consumer prices for computers and electronics, and semiconductor profitability. Based on this model, we predict a 5-year sales CAGR of 15%, which is consistent with AMD's average long-run growth. As you will see further, under a base case, we expect COGS and R&D to grow in line with revenues, with considerable variation under best and worst case scenario. We also expect their margins to remain consistent with short-run averages going forward.
In order to value AMD, we constructed a DCF valuation under 3 scenarios. And for each scenario, we accounted for macroeconomic conditions, industry factors, and firm-specific assumptions. Using the forward-looking options market, we then calculated the weights for each of these scenarios by deriving market implied probabilities. We also utilized a Monte Carlo simulation to account for the uncertainty in our DCF, simulating a variety of drivers. Now, AMD's capital structure is nearly all equity. Therefore, for each scenario, the free cash flow to equity and terminal value both was discounted at a dynamic cost of equity instead of a WACC. This cost of equity falls over time as AMD matures and its beta shrinks. To complement our DCF analysis, we conducted a relative valuation comparing AMD to 10 of its industry peers. Using median peer multiples yielded a comparables price of $70. Finally, we developed our own novel econometric model linking AMD's intrinsic value to the fundamentals of the semiconductor industry. This model links AMD's price to the value of computer shipments, production of computer components, and production of circuit boards. Based on this industry model, we estimated the fair price of $71. Our estimated final fair value of $72 is a weighted average of these three models. Our target price of $86 represents a rate of return 29% below the required rate of return relative to the market closing price on April 10th.
Recently, greenwashing and ESG manipulation has become an investor concern. Accordingly, we adjusted our ESG scoring system to reflect the quality of rating agency. Using these weights, our ESG scoring system is a weighted average of FactSet, Morningstar, and Refinitiv. AMD scored below its key competitors in the industry. 33% of AMD's board are women and 22% are racial minorities. Additionally, AMD must comply with regulation on disclosure of conflict minerals and ensure that there are no occurrences of forced labor in their supply chain.
1 minute.
We identify the following significant risks to AMD. First, the US banned the export of AI computing chips to China. Additionally, Intel is the primary beneficiary of the CHIPS Act, with much of the funding allocated to expanding manufacturing capability in the US. The Made in China 2025 plan aims to onshore both designing and manufacturing of semiconductors to China. Second, the inability to retain talent can lead to less innovative and less competitive products. Semiconductor engineering is highly specialized, and talent scarcity can lead to fierce competition among industry rivals, with AMD's main competitors being better positioned to acquire talent. Downward trends in skilled immigration since 2016 further intensified this problem. These risks, in addition to other operational and market risks, have large valuation impacts should they fully materialize. To close, we restate our sell recommendation based on AMD's weakening economic moat, strong cyclical headwinds, and geopolitical uncertainty. Thank you. We'll now open it up for questions.
Thank you. Judges, at this time, please turn on your videos. Please stay muted unless you are speaking. I will start time as soon as the first judge begins asking the first question. Time will end at 15 minutes. Feel free to begin when you are ready, judges.
Hi guys, congratulations for the presentation. My first question is related to the capital structure of the company. What would it happen to the company's DCF if the company reduces its cost of capital by adding debt to its balance sheet? And is it that a low-hanging fruit that management can take this measure in order to increase the value of the company?
Thank you for your question. Yeah, so we've seen over the last couple of years, AMD really reluctant to take on debt. In fact, they've been continuously paying down the debt in favor of that high cost of equity. So in the future, this is an indication that they may not have attractive products that they need more cash to invest in. So definitely something that we'll be looking at moving forward, and management does need to pay attention to. In terms of what that would do to the value of the company, obviously we would shift our analysis towards a WACC if they were to incur more and more levels of debt in relation to the market value of their equity. However, at this time, our valuation does reflect that high cost of equity, and that WACC coming down would increase the value of the firm.
Congratulations on a really strong presentation. I'd be very interested to understand what the company's foreign currency exposure is, especially in relation to its largest competitors.
Ben,
Thank
if
you for
could
asking
pull-
that question. So we actually did a valuation impact considering foreign currency, and we determined that it would be a less than 1% price impact if these problems were to materialize. They have a very robust foreign currency hedging program, so we don't see that as a very significant risk to AMD.
In addition to that, a lot of their sales are dollar denominated. So
Hi guys, I wonder if AMD shifts to the ARM structure, how much would the company have to spend in R&D? And what do you think it would happen to the company's competitive position and to the company's value if it shifts from the x86 to the ARM structure?
Yes, thank you so much for that question. We do believe currently AMD is underperforming when it comes to ARM. They do not have any R&D that is devoted to it. They are constantly focusing on x86. In order to invest into ARM, they would have to either acquire a firm that has already developed intellectual property surrounding the ARM architecture, or pour a lot of money into their own R&D to develop that structure. As far as acquisitions are concerned, the $49 billion acquisition that of Xilinx is a huge acquisition to digest, and AMD themselves have reported that they do not plan to acquire any firms in the near future.
Yeah, I think he is like on his phone.
I'm sorry. And moreover, it's also worth noting that Intel just signed a multi-year deal with ARM to produce ARM architecture chips here in the United States, which puts them in a significantly competitive position and provides them with the edge over AMD when it comes to ARM going forward.
To add on to that, AMD, Ben, if you could pull up the intellectual property analysis, AMD has been performing a little bit better once their CEO, Dr. Lisa Su, came on board around 2016. And as you can see, their patent portfolio really went up around that time. However, since 2019, it's been stagnating quite a bit. And Intel, even though it's been underperforming in the recent years, they're the fifth most largest patent holder in the world, which we see as really a threat to AMD in the future and their ability to innovate.
And since innovation is such a key driver for this industry, we see that additional R&D allocation will benefit AMD's future innovation prospect.
Glenna, we are still not hearing you. I'm gonna, yep, go ahead.
Ask if you are wrong about your investment thesis, what will be the two top reasons that you are wrong?
The two top reasons that would be wrong, one of them is if the terminal value does not materialize as it is 80% of our actual price. And this is one of the main reasons. And then the other one would be also that Intel keeps underperforming and AMD just keep that upper hand on the industry.
Okay.
just to add on to that, our analysis is based on the fact that Intel will reverse the course that it's been taking in the last 3 or 4 years and continue to deliver on product roadmaps that we've seen previous to AMD's renewed success. So if Intel continues to stumble and AMD continues to gain traction, then that is going to be a significant risk to our valuation. And that was slightly accounted for in our DCF modeling, in our best case and worst case. But that, again, that best case is only representative of 12% of our final DCF intrinsic value.
Okay. Glenna's question, she just messaged it to me since her audio is not working at the moment. She says, what is the difference between the fair value of 72 and the price target of 85?
Thank you for asking that question. So the fair value is the fair value today based on our DCF model, or based on the weighting of our DCF comps and our industry model. And the target price is that price discounted forward at AMD's cost of capital.
Can you guys run through the AMD's strategy and contrast with Intel's strategy and other competitors?
Could you repeat the first half of that question? Sorry, I think you cut out.
Sure. Can you run down AMD's strategy and compare AMD's strategy with its competitors?
Yeah, for sure. I can speak a little bit about their products. If Ben, could you pull up the product comparison? So AMD is really focused on trying to go for the higher end market. Intel has had a moniker for years where they develop the products that are just good enough and sell them at a lower price. So AMD is really trying to focus on the middle to high end of the market, on specifically for CPUs. So if the demand for the CPUs isn't there in the next couple of years, given recessionary impacts, downturn in the business cycle, then AMD is really going to suffer larger price impacts than other competitors like Intel. With NVIDIA, we see a premium demanded for their products just because their products are just flat out superior to all the other products on the market in terms of AI and some of their data center products. So that's a little bit about AMD's product roadmap, and Intel's product roadmap is really focused on, they are a vertically integrated IDM. So they're really focused on bringing home that manufacturing right now. In addition, in parallel, designing those better CPUs that are more affordable in the data center operations and for the original equipment manufacturers that design and manufacture those PCs.
Also, to add on to the same, Ben, if you could go to the slide with the memory chip price cuts. Thank you so much. We can also see how these strategies unfold out in the market. Due to recessionary pressures and falling chip prices due to lower demand, we can see that the price cuts for AMD's top line chips have suffered a lot more than Intel and NVIDIA. And this pushes us to believe that Intel and NVIDIA have a lot more pricing power than AMD does. Moreover, Ben, if you could go to the slide with Intel's financial position. And we can also see that Intel spends a lot more money on research and development, has a higher cash reserve combined with an already higher market share when it comes to x86. We believe that this is why, with a more comprehensive patent portfolio, we believe this is why AMD is going to be unable to compete with Intel over the long run. Moreover, Intel has been making a lot of deals, as well as has very comprehensive roadmaps to produce products over 2023 and 2024 that are set to beat out current AMD top line products.
And to add a small note about NVIDIA, because it is also one of their main competitors, they do hold about 88% of the AI market, which we don't see AMD being able to really compete with that in the future, or at least in the short run.
Okay, Glenna has another question. Where are they most different than the market that leads to their market price being below current price?
So we talked a little bit about the concept of derived demand that supported our analysis. And we really believe that the market is over anticipating the demand for these computing end products moving forward. So yeah, we see that COVID exuberance was priced into the market and the stock ran all the way up to $160. And we haven't seen that hit of realism in consensus expectations like our analysis supports. Happy to explain that further. Sorry.
I would add that the market seems to be reacting to new product news and things of that nature at this time. But we see the more important story being on the actual demand side, seeing as so many people replace their hardware over COVID. We don't think that new shiny products are going to stimulate that demand from the consumer.
Could I ask, do you feel strongly enough about your sell recommendation to short the stock, or is this merely a stock you would avoid?
Thanks for your question. There is a lot of variance in our economic growth scenario and our hard recession scenario. So if any little one of those assumptions pans out, the stock could really pop. As we mentioned, the market is reacting to a lot of overhyped product news. So this is not something that we're saying short, just because of the volatility in the stock. That short position could get hammered pretty quickly.
Thank you.
To also slightly add on to it, Ben, if you could go to this slide where we state our confidence in our sell. We can also see that according to our Monte Carlo simulations, the result was to sell 58.4% of the time. This is our main confidence in our sell that is supported by our novel industry pricing model, as well as the econometric model that we use to forecast sales going forward. And that's essentially where a lot of the confidence in our sell comes. But just backing up what Brendan said, there is a lot of volatility currently with market sentiment as well. So currently our confidence is in our sell.
Thank you.
And that is time.
Hi, everyone. We are the University of Waterloo research team, and this is our recommendation for our subject company, Payfare. Payfare completed its IPO in March of 2021 at $6 per common share, and the company is now currently trading at $6.99 as of Monday's close. We are issuing a sell recommendation for Payfare at a target price of $5.15, which represents a 26% downside to the current price. Our investment recommendation is driven by the following 3 thesis points: Payfare's high customer concentration, their lack of a competitive moat, and capital challenges the company will face in the near future.
Payfare offers earned wage access, or EWA, within the gig economy, which provides workers access to some or all of their earnings that they have already accrued before their regular pay period. This is a solution to shorten the gap between the cash needs for immediate expenses of gig workers and how slowly they were being paid. They accomplish this through providing an app and a debit card that can be integrated with gig platforms. Platforms then invite workers to enroll on the app for earnings payments, and once enrolled, each gig worker will receive a Payfare-issued bank account and debit card. Workers can use the app to manage their earnings and spend money using their Payfare debit card on their daily expenses. When workers spend, the merchants will pay an interchange fee on each transaction, a portion of which becomes revenue for Payfare. We will now use an example to show how $10 of earnings flows from Payfare to the gig worker and is finally spent at a merchant.
There are 5 major parties within the Indian system: Payfare, issuing bank, a payment processor, the card network, and a merchant bank. In our example, the gig worker will spend $10 earning at Starbucks, and Starbucks will collect that $10 and pay 3% or 30 cents to the interchange system. Payfare typically receive 2.2% interchange fee, which is 22 cents, and the other 4 parties will receive the remaining 8 cents. Interchange fees make up 75% of Payfare's total revenue. In addition, the remaining 25% are user fees. These fees come from users making ATM withdrawals, money transfer, and foreign exchange, and they're based on the number of transactions.
We've identified key headwinds for the payment industry, which are interchange fee reduction, economic slowdown, and tightened regulations. The main headwind affecting the payment industry is the interchange fee reduction, as it significantly reduced the interchange fee ever since the Durbin Amendment was enforced in the US, which puts a fixed cap on debit card interchange to reduce business costs for merchants. With regards to tailwinds, the payment industry is constantly creating new products to better serve the digital needs of a changing demographic, which will drive future growth. Payfare competes against 3 main segments: the gig platform themselves, big fintechs, and other comparable companies. Gig platform can and already have in-house technology that can provide EWA. Second, big fintech can provide a lower cost solution because of their strong technological capability. And third, there are other comparable companies who provide a similar product.
We will now dive into our investment thesis. First, we believe that Payfare has a high risk of revenue loss due to their high customer concentration. Payfare has 3 customers from which it earns the majority of its revenue: Uber, Lyft, and DoorDash. Out of those 3 customers, DoorDash and Lyft make up 97% of total revenues, while Uber makes up 3%. There is a high risk that Payfare will experience cannibalization from its own customers as they turn toward in-house technology to replace Payfare's function. This is evident with Uber, who partnered with Payfare in 2016 on a 3-year exclusivity contract. As its exclusivity came to an end in 2019, Uber rolled out its own financial services division, Uber Money, to service its drivers, and there is a high risk this same process will occur for Payfare's other customers. We spoke with 2 former executives at Uber Eats to confirm our prediction, and they said it is typically easier to partner with companies like Payfare at first, but once a new function is proven to be effective, they would rather dedicate a team to build it in-house.
With respect to customer concentration, Payfare has low bargaining power due to its relative size and functionalities. Payfare's management mentioned targeting margin expansion through obtaining a greater cut of interchange fees, but we view this as being very unlikely due to the nature of the interchange system and the downward trend of where interchange fees are headed. Normally, the payment processing system functions with only these 4 parties. Payfare provides a banking app and addresses the end user in this case, which is typically done by the issuing bank. Out of the 5 parties, the only non-essential function is Payfare. Against parties like Visa, MasterCard, and the banks, which we do not think will accept a lower portion of the interchange fee, Payfare does not stand a strong chance to negotiate a greater cut.
In addition to potential revenue loss, Payfare's growth prospects are extremely limited and difficult to execute. Management intends to grow the business through expansion into adjacent markets and new geographies. However, we view both avenues as difficult business venture for Payfare due to high competition and regulatory challenges. In adjacent markets such as trucking or fast food, most customers already have a dedicated and tailored EWA provider, which they're unlikely to switch from. In addition, Payfare's platform was catered for drivers, which could make it not suitable to service other gig platforms and their specific needs. And in new geographies, Payfare will be challenged by a number of fintech regulations which requires significant time and capital to bypass.
Elaborating further on capital and constraints, Payfare does not have a strong financial foundation to execute on its expansion plans. Over the past 7 quarters, Payfare has seen a significant increase in the customer acquisition cost, or CAC, as management continues to push forward on its expansion plans to acquire new customers in markets where Payfare has no footprint. However, as the CAC grows, both the GDV per user, which we thought of as value per customer, and gross profit per user have not nearly caught up. This relationship shows that Payfare is spending more money to acquire customers that are not lifting their bottom line. In addition, ever since the paid app was launched in Q2 of 2022 to attract smaller gig platforms in adjacent markets, CAC has increased from $6 per new user to $31, while active user growth declined materially due to low traction on the app. As new user growth slows down and the gap between CAC and gross profit increases, operating leverage will continue to erode and exacerbate their bottom line. We assess the impacts of our investment thesis on intrinsic valuation using a 10-year DCF. First, Payfare's high customer concentration, coupled with the likelihood of customers turning in-house, will have an adverse impact on GDV growth. We believe Payfare cannot sustainably grow at management's expectations of 100% year-over-year and of thus low GDV to a CAGR of 20%. Next, low bargaining power in the payment chain will lead to a decrease of 200 bips in Payfare's interchange fee received on total transactions. Third, we believe Payfare's expansion into adjacent markets will be largely unsuccessful, meaning less headcount devoted to these ventures over time while CAC continues to rise, resulting in a 150 bips decrease to salaries and a 200 bips increase to COGS. These key assumptions led us to a downside of 30% in our DCF using a perpetuity growth rate of 2% and a 28% downside using our exit multiple of 10x when applying our WACC of 15.8%.
In our comp analysis, we consider 6 companies segmented by what we view to be Payfare's 3 main business components: platform and integrated payments, consumer finance, and payment processors. We took the first quartile of our comp set as we believe Payfare should be trading on the lower end of our multiple range, since many of their competitors are high growth companies. Using EV over next 12 months revenue multiple of 1.2x, we arrived at a share price of $5.66, implying a 19% downside.
Finally, we also value Payfare using a precedent transaction analysis. For our precedents, we consider transactions of high growth payment companies in the last 5 years with a similar business model to Payfare's. Using the median multiple of our precedents, we arrived at a target price of $4.95, implying a 29% downside. Overall, weighing our DCF at 50%, equally blended between terminal growth and exit multiple, our comps at 25%, and our precedents at 25%, we arrive at a total implied share price of $5.15, representing a 26% downside. The 2 risks with the highest likelihood and greatest potential impact on valuation are the risk of interchange regulation remaining unchanged and the business risk of Payfare successfully executing on their growth initiatives, which we factored into our bull case. We also internally developed an ESG scorecard to assess Payfare and its peers out of 4 across 14 ESG categories. For the environment component, we evaluate Payfare's carbon footprint, business activities, and the timeliness and transparency of their environment-related disclosure. Payfare scored 1.88 due to their lack of environment-related disclosure.
Looking ahead to the social component, we evaluate Payfare based on its workforce, community, product management, and disclosure. It scored 1.67 on social due to the lack of initiatives to support the community and enhance workplace diversity.
Lastly, for governance, we evaluated Payfare based on its board, management, audit committee, compensation, shareholder rights, and disclosure. Payfare scored a 3.69 overall as they have a qualified team and high disclosure. We gave Payfare a combined score of 2.41.
1 minute.
Than its peer average of 2.70 due to Payfare's lack of disclosure with respect to CSR reports. Our score was factored into our beta.
To conclude, we are issuing a sell recommendation for Payfare at a target price of $5.15, representing a 26% downside to the current price. Thank you very much. And now we will open the floor to any questions.
Thank you, team. Before we get started on Q&A, I just want to make sure, Maura, are you set? You're muted right now. Nope, can't hear you. You're muted, but I see you connected on 2 separate devices. I can see the video on both of them. Let's see.
Can you hear me now?
Yes.
Okay, I got kicked out from the main meeting. So what I'm getting is some feedback on my iPad. I'd like to assure the students that I was following along on my iPad and I did not miss any of the slides.
Okay. Should do you want to try unmuting on your iPad instead of on here? Because we're getting some feedback from hearing it. Or if you
okay.
Okay. Maura, let's see. I'm gonna ask you to unmute on this device. And then if you can turn off the volume on your iPad.
Okay, coming up. Can you hear me now?
Yeah, there's still a little bit of feedback.
Okay. The only thing I can do is put my iPad in a different room. Okay, sorry, team.
That's okay. All right, so we are ready for Q&A. So whenever you all are ready, judges, you may begin. It will be 15 minutes and we will stop at that point.
Guys, your investment thesis is quite clear, but I have to ask, why is the market missing such a challenging environment that you're seeing crystal clear?
So we believe that the market has overvalued management's expectations on their expansion plans and discounted the risk that Payfare will lose its customers from their customers turning towards in-house technologies.
So could you address the ownership of the stock? You mentioned it was an IPO in March of 2021. Is it closely held? Is it institutionally held? Is there a lot of hot money?
For sure. So currently Payfare is 13% owned by insiders, 21% owned by institutions, and 66% owned by other shareholders and investors. So it is not majorly closely held.
5%. Is one risk to your thesis acquisition?
We think that the acquisition risk to our thesis is low, mainly because one of the reasons for a company to acquire Payfare is trying to capitalize on its user base, which is established with the current gig platforms. However, the strategic reason is significantly drawn back if one or all the gig platforms were to turn in-house. So we think that this is not attractive for Payfare to be an acquisition target.
And on the technology front, these companies, like you mentioned, are doing a ton of innovation. What are they doing to keep up with their peers, and what do they need to do that they may not be doing?
Yeah, so recently Payfare has announced several partnerships, and we see this as their attempt to grow their revenue and increase stickiness, especially for their DoorDash customers. However, this doesn't tackle the core problem for Payfare, as they still have a high customer concentration risk and low competitive moat.
And if we could, adding on to that, if we could scroll to the technology comparison slide. The reason why we believe Payfare does not have a competitive moat is because in each of their competitor brackets, all of the players within, whether it's in-house technology with their customers, public comparables, or big fintechs, have more capabilities, technological capabilities than what Payfare is offering right now. And so we believe that within the competition landscape, Payfare does not stand out in its service offerings.
Are there things that should be offering that it's not offering right now?
So currently its competitors have virtual card options, which Payfare does not offer, as they only have a physical card option. In addition to that, there are also many other AI capabilities and virtual capabilities that many different technologies, such as those offered by the in-house technologies of Uber and Lyft and Stripe and PayPal, offer.
Could you address some of your ESG concerns about the company?
Yep. So in terms of ESG, we gave Payfare a very low rating due to the fact that they have a lack of disclosure with respect to their CSR reports and that they currently don't offer any virtual cards, whereas a lot of their competitors do, which resulted in a very low ESG score.
Can you talk more about the executive compensation and the incentives that they have?
Yep. So in terms of executive compensation, currently management is compensated through a combination of a base salary, share and option-based awards and bonuses. And in 2021, approximately 64% of the CEO's compensation was from equity awards.
Apart from an eventual loss of a client, what is going to be the main trigger for the stock to go down?
So apart from their customer base, which is already bleeding out, we see another potential risk on the horizon being interchange fee regulation. So we saw that historically happen with the Durbin Amendment when that was enforced in 2011, which essentially put a fixed cap on debit card interchange fees, and that caused a ripple effect across the entire system. And so those fees were reduced. Since Payfare earns a majority of its revenue from interchange, they're now seeing regulations such as the Credit Card Competition Act come into effect in the States, which essentially allows merchants to choose card networks with lower rates. And so if that were to pass through, we expect that Payfare will earn an even lesser portion of the interchange that they already have a low portion of.
Can you talk a little bit more about the expansion plans that management has said they think they can do that you don't believe in, and why not?
Sure. So some of the geographical expansion plans that Payfare has stated that they want to undertake include expanding into the EU and Australia. However, we view both of these two regions as particularly tough to break into and set up operations in because there are regulations in both of these geographic areas. So for example, in the EU, there's a fixed interchange fee cap, which would not be beneficial to Payfare's overall business and their revenue model. And then in Australia, there are also strict regulations that Payfare will have to follow. And so they will need significant time to bypass these regulations and to set up business in these new jurisdictions.
You guys discuss a lot about what can go wrong and what can go right in the stock, apart from being a target of an acquisition, apart from that.
Yeah, so we think in order for things to go right for Payfare stock price, they would essentially have to make sure that all of the downsides are covered and the upsides are realized. And so what I mean by that is, first of all, they have to ensure that none of their customers leave the platform, and instead they increase penetration rates into their current base of customers while adding new customers from adjacent markets that they're targeting, such as trucking, social media influencers, and other gig segments. And they would also have to probably expand geographically, or successfully expand geographically into one of the markets that they're targeting in order to, satisfy this well over 100% growth that management is speaking about.
Another question here, what was the rationale for the company to do the IPO about, let's say, a year ago? And why the expectations got frustrated, at least looks like?
Yeah, so we believe that Payfare really took advantage of the good timing in the market during the bull run in 2021. And so fintech fintech valuations were just at all-time highs during the period in which they chose to IPO. And prior to their IPO, the company was actually largely financed by debt. And so they really wanted to raise equity in order to pay down that debt and have cash on hand for their future expansion plans. And so we believe it was just good timing that the company chose to do so. Yeah, so that was a strategic rationale.
And was there a secondary offer, or was it only a primary offer?
It was just a primary offering.
So did your team get a chance to interview management on the IPO or listen to the IPO presentation?
We did not get a chance to interview with management. I think as part of our research, we did get one call with the head of investor relations, in which we mainly went over the business model and the growth avenues that Payfare was targeting. So less of the conversation was focused on the IPO. However, when we did go through research ourselves in terms of, why Payfare decided that it was a good decision to IPO, is mainly just access to capital was really easy at the time. And it was what the company needed in order to fund its operations moving forward and some of the growth initiatives that we talked about.
Thank you.
And what did the company raised?
Go ahead.
Sorry. How did the company use the proceeds of the IPO?
Yeah, so prior to the IPO, the company was financed largely by debt, a mixture of different types of debt that the company took on in order to fund their operation. So a large portion of the IPO proceeds went to pay down that debt, and that's why the company has cash on hand, has the cash on hand that it does right now. Prior, it did not. So yeah, so after paying off the debt, the rest of the proceeds were held in cash.
You kind of list capital challenges as being a thesis, but we kind of didn't really discuss things about needs for funding and how much they're currently leveraged, cash flow, those kind of things. Are they in need of capital soon? Maybe it is because of their expansion plans, but normally businesses like this aren't terribly capital intensive.
Yeah, so if we actually try to create a proxy for how much cash Payfare has been burning historically. And so in terms of their need for cash, if we analyze pre-IPO, their cash runway was around 7 years. But then after IPO, when management announced all of these really aggressive expansion plans, at their current run rate, they would run out of cash in 4 years just based on their operations alone, not including any of the expansion plans that we talked about. And so if they were to go and try and acquire new customers, which are more expensive in these new gig segments, as well as target something as big as geographic expansion, we believe that their cash on hand will not sustain that.
What would make you bullish on the stock? What change could management make? What could happen that would make you say, oh, hey, we're wrong?
So in order for us to be bullish on this stock, we would have to believe that management would be able to fully retain their current customer base of Uber, Lyft, and DoorDash while increasing penetration with all three of these customers. And then in combination with that, they would also need to execute on all of their expansion plans that they've stated. And so overall, just based on our thesis, we view this as unlikely.
What motions have Lyft and DoorDash made towards making their own payment platform, if you're concerned about that as being a risk that they could lose them just like they did Uber?
Yeah, so currently based on our research, we've noticed that DoorDash and Lyft have actually been developing their own in-house technology. So DoorDash has their in-house technology called FastPay, and Lyft has ExpressPay, and both offer the same EWA capabilities that Payfare has to offer. And so using the Uber case as an example, where a large number of the active users with Payfare that were from Uber. After the exclusivity ended, the number of active users significantly decreased. And so with DoorDash and Lyft developing FastPay and ExpressPay, as their exclusivity comes to an end in the near future, we believe that there will be a significant drop-off in revenue similar to what happened with Uber.
So do we know when those contracts end, when the exclusivity ends?
Yeah, so the Lyft contract ended in May of 2022. And for DoorDash, it's going to end later this year in October of 2023.
In your view, what's the probability of this company to be acquired by someone else?
While there is
Go ahead, Sonia.
While there is a chance that Payfare could be acquired, we view this as having a very low probability due to the fact.
We recommend a buy for Chipotle with a price target of $2,400, providing a 40% upside. Chipotle's innovative combination of an assembly line service model and high-quality ingredients creates unparalleled value. With its effectively executed operating model, Chipotle has all the ingredients for success. Chipotle offers the best value proposition in the fast casual industry, providing a 20% price gap to peers. Customers love Chipotle's value proposition, and the ability to sustain this at scale gives Chipotle a strong competitive advantage. With a large lead over its peers, we expect Chipotle to easily double domestic store count up to 7,200 stores, while also having a long runway for growth in untapped international markets. The substantial throughput from this expansion will only strengthen unit economics, and new technology will accelerate profitability. Supported by its improving ESG initiatives, Chipotle's growth will be fast and organic, as its accelerating free cash flow supports self-funded expansion while also having excess cash to return to shareholders.
Chipotle pioneered the fast casual concept in the 90s and remains the market leader today. Its efficient business model, menu design, and store layout provide operational advantages that keep costs low and create the strongest value proposition in the fast casual segment. To quantify this value proposition, we identified 7 fast casual peers who offer entrees at similar price points to Chipotle's standard chicken burrito. Across the top 5 cities for each brand, we found the average price of a standard entree and compared it to Chipotle. And we found that without sacrificing quality, the average Chipotle entree is up to 20% cheaper than average entrees from competitors. This wide price gap gives Chipotle significant optionality against peers. It can increase prices to expand its margins further, or maintain its discount to peers and continue taking market share. The fact that Chipotle has been able to maintain and even expand this value proposition through explosive growth is a testament to its strong execution. This is due to Chipotle's fully corporate-owned store model, which reduces operational risks, combined with a debt-free balance sheet. While Chipotle's operating leases are similar to debt, they are not reliant on capital markets, and we expect Chipotle's value proposition to make it a preferred tenant with landlords. Chipotle's price gap and operational advantages have historically been a magnet for throughput, resulting in our forecasted same-store sales growth of 5.6% annually through 2032. Based on its wide price gap, we believe Chipotle can take price in the short term and sustain high transaction growth as it grows store count in its large domestic market.
Chipotle currently operates over 3,000 stores in North America, and our projections show that Chipotle has the potential to more than double its store count. We conducted an independent store density analysis to confirm the company's domestic tangible addressable market, or TAM, by finding the 30 cities where Chipotle achieved the highest density of stores per person and applying the average density to North American cities with over 35,000 people. Our research concludes the potential for more than 7,200 stores within North America. Chipotle consequently still has massive domestic store growth potential. They can realize this potential through Chipotlanes or Chipotle's mobile pickup windows. Stores with Chipotlanes have 15% higher AUV than regular stores from increased digital throughput, and we believe Chipotlanes will drive substantial store expansion. We consequently forecast store count growth growing 11% annually before slowing as Chipotle reached our 7,200 store count in 2032. Even after reaching our domestic store count target, Chipotle still has the potential for expansion into untapped international markets. We conducted the same TAM analysis with more conservative assumptions when looking at the top cities in Europe and Asia, where we believe Chipotle could expand the easiest. Our TAM derived a 2,600 store count potential in Europe and a 3,200 store count potential in Asia. Quick service brands like McDonald's and Yum have seen significant success in Europe and Asia by adapting menu items, and we believe Chipotle's modular menu design gives them similar flexibility to find success. By 2032, our forecast only incorporates 800 international stores. While we do not see Chipotle reaching the global store counts of McDonald's and Yum, having just a fraction of their store base gives Chipotle the runway for years of potential sustained store growth.
Along with strong store expansion, Chipotle's unit economics allows for same-store sales to catalyze margin expansion, driving our forecasted 29% restaurant margins by 2032. With labor and occupancy costs largely fixed on the restaurant level, throughput will be a substantial contributor to margin expansion, and our historical analysis shows the potential for over 4% margin expansion through sales leverage alone. This will be bolstered by automation, as Chipotle is already investing in initiatives to increase efficiencies, ranging from mobile ordering, Chipotle lanes, and food preparation automation. While these technologies are still being tested, Chipotle's modular menu design, corporate-owned structure, and experience management should allow for seamless integration of these technologies throughout all stores. Even when considering increased marketing investments, which could contract margins, Chipotle has a strong path to 29% restaurant margins and 18% operating margins by 2032.
After independently ranking Chipotle's environmental, social, and governance practices, we see numerous initiatives that lower the risk of the business model, justifying its below average cost of equity due to lower financial leverage. Environmentally, Chipotle's most impactful practice are their large investments in local farmers, which we believe will only enhance and prolong the sustainability of their supply chain. Socially, Chipotle emphasizes the clear career path available to restaurant employees and boasts a 90% internal promotion rate. While Chipotle has prioritized diversity at their restaurant level, they've yet to do so with their board. Currently, only a quarter of the board are women or minorities, and we see this as Chipotle's primary area that needs improvement. While third parties do rank Chipotle lower in governance due to board and management turnover, we see the addition of CEO Brian Niccol as beneficial due to his strong track record at Taco Bell and other Fortune 500 companies, as well as his successful turnaround of Chipotle's brand. Brian Niccol and the rest of management are also well aligned with shareholder value creation, as their compensation is tied to 90% of variable performance elements.
Chipotle's strong and sustainable growth leads to substantial free cash flow generation. In our forecast, we utilized our 5.6% AUV and 8.7% store count annual growth rates to drive our forecasted 16% annual revenue growth. With strong store expansion, capital expenditures will accelerate, and we forecast them growing 15% annually. And despite this growing scale, we still see restaurant margins reaching 29% and operating margins reaching 18% due to sales leverage and automation. The result is free cash flow growing 18% annually throughout our forecasting period. With this substantial free cash flow generation, Chipotle has significant excess cash, which they can return to shareholders in the form of dividends and share buybacks. When we incorporate this into our earnings model, EPS grew 22% annually on top of our expectations that they can start issuing a dividend after 2027. With this cash flow generation, we derived our 2,400 price target, representing a 40% upside to the current price. For our valuation, we utilized a 10-year DCF and an 8.4% weighted average cost of capital, which we believe incorporates Chipotle's lower risk business model due to their financial and operational strengths, as well as improving ESG. For our terminal value, we utilized the price to earnings exit multiple method to account for Chipotle's lasting growth internationally. And our multiple represents a 10% discount to current quick service peers growing internationally to account for the potential of lower penetration than this peer group. To confirm our DCF price target, we compared it to multiple other relative valuation methodologies using the same 10% discount to peers. And the results confirm the significant upside that we see in Chipotle stock today. However, we recognize that there are risks to upside materializing. The primary one being Chipotle's already high valuation as their price to earnings is double that of the industry average. However, our forecast shows that they can quickly grow into this valuation over the next 5 years, making it a strong opportunity today.
Chipotle may also face challenges with its ambitious plans to both improve unit economics and double store count. Our sensitivity analysis of AUV growth, store growth, margins, and our exit multiple does show potential downside. However, we remain confident in Chipotle's continued value creation due to its lasting competitive advantage, and our TAM analysis shows a significant growth runway without interfering with current stores.
Finally, we recognize that international growth for Chipotle must be proven. When we incorporate this risk using the terminal growth method in our base case, we see a downside if growth cannot persist. Nonetheless, Chipotle's simple business formula is easily transferable outside of North America, and CEO Brian Nichols' prior experience at Taco Bell and other Fortune 500 companies should allow for franchising if needed. Franchising would help reduce operational risks and provide long-term tailwinds for continued margin expansion, justifying our PE exit multiple methods.
To conclude, Chipotle's simple business model sets them up to serve affordable, convenient, and high-quality products to their growing customer base domestically and internationally. With their debt-free balance sheet and corporate-owned strategy, their growth runway is clear. And when combined with improving unit economics, the substantial free cash flow generation results in underappreciated value for investors. Thank you for your time.
Thank you, team. Judges at this time, you can, well, your videos are already on, so please stay muted unless you're speaking. I will start the Q&A timer as soon as the first judge begins asking the first question. You will have 15 minutes. Feel free to begin when you're ready.
Hi, I was interested in the price gap analysis that you said you did personally. Could you share the scope of that analysis and how you conducted it?
Sure, yeah. Jerica, if you could please go to slide 4. So I can step you through first the methodology in which we chose these peers. We looked at a few different factors to determine what would be appropriate. First one being that each of these brands could be described as a fast casual restaurant as opposed to a quick service restaurant like McDonald's or a casual dining restaurant like Applebee's. Second thing we looked at was geographic focus. So all of these brands are primarily North America, across North America, and they have locations across the country. Third thing we looked at was caloric content and portion size. And so pretty much how we selected each of these prices was we looked at the 5 states in which each brand had the most stores. And then within each of those states, we looked at the city that had the most locations. And then we went onto the mobile ordering website for each brand and picked the price out for our chosen entree.
Thank you.
Guys, something that is letting me a bit uncomfortable with the following. As you mentioned, you're forecasting a substantial growth in number of stores and a substantial growth in same-store sales. So the company is moving to, let's say, second-tier, third-tier locations. And in spite of that, your margin is expanding a lot. How comfortable are you with that? And can you provide me more details on your forecast?
Yeah, I can start us off and walk you through that. Jericho, please for slide 35, if you can. So we understand that we are projecting Chipotle will double its store count domestically. And when we did our TAM analysis, we looked at cities where there were only 35,000 people or above. So we wanted to eliminate a lot of these rural cities where we believe that Chipotle cannot expand successfully. And so when we did our TAM analysis, we found out that there is still substantial room for them to grow. And even more than that, when we did our TAM analysis, we found that over half the cities that could have a Chipotle currently do not have one. So we believe that through their corporately owned structure, that they will be able to help pinpoint exactly where they want these stores to go. And in addition, they will hopefully eliminate store cannibalization in the process.
One thing I would like to add as well to that is that in Q3, Chipotle in their management, in their investor relations call, they did state that one of their first locations in these more suburban locations in specifically Texas, after their opening, they did notice that the margins at this specific restaurant were comparable to their overall average restaurants. And so this gives us confidence that, the demand is out there for Chipotle and what they offer.
Okay, I have paused the time for a moment. I'm just going to try to get Glenna to be able to unmute and ask a question here, and then I will restart the time once we hear her.
Can you hear me?
Yes, we can hear you.
Okay, all right. So do I need to unmute myself on the screen in addition to my cell phone to talk? I just don't know how this works then. We'll see. We'll give it a try. But,
Okay.
yeah, so overall, my question is about the 7,200 stores. Again, how do you compare that to, like, who else can you look to say, hey, you know, they're not McDonald's. You mentioned that they are indeed fast casual instead of QSR. Why does it make sense that they can get to 7,200 stores, and why is their same store sales at around 5% sustainable?
Yeah, so going back to our TAM analysis of why we think that they could achieve 7,200 stores, again, we looked at the corporately owned store structure for Chipotle, where we understand McDonald's and Taco Bell's, they do have the opportunity to franchise. But if Chipotle were to franchise, they would lose a lot of this corporate control that they have. And after the food safety crisis, they wanted to maintain that control. So through our TAM analysis, we just focused on cities where Chipotle could expand successfully through their population density, and focusing more on suburban areas as well as they look to expand Chipotle lanes, which generate higher throughput and higher AV.
Yeah, and we definitely recognize that as Chipotle doubles the store count, store cannibalization is a large risk, especially with our forecast of same-store sales. So to look at the impact of this, we conducted a sensitivity analysis to see what would happen if they reach our store count goals, but they're not able to reach our AUV forecast, especially since if they're not able to reach our same-store forecast, that will also impact the sales leverage in our margin assumptions. And what we saw was that even if they're not able to reach our forecast, there's still a margin of safety where there is potential upside if they don't reach our forecast.
Hi, I was interested on slide 20. You said that you had conducted your own ESG work and that you had some differences with some of the major ESG providers for the street. Could you explain what you did and why you differ, for example, from some other leading providers?
Yeah, thank you so much for that question. Jericho, if you could actually go to slide 71, that would be great. This is the breakdown of how ours differ and other various third parties that we looked at. So one thing that we noticed when looking at all these various platforms is that it's a lot of aggregated data. And with this, we noticed a lot of sections that were just completely missing from their ranking, which we believed impacted score. As well as for specifically with governance, we noticed that Chipotle was marked down heavily for their board and management turnover. But so when we decided to do our own independent analysis, we decided to have a forward-looking outlook, seeing as though we're very confident in management and the ESG initiatives that they have put in place. And we see that Brian Nickel, as well as the rest of the board, really, for example, environmentally, they just recently released a new blueprint on what the future Chipotle stores will look like. And this includes an all-electric base, which is for what is supposed to help them get to one of their main goals of reducing greenhouse gas emissions by 50% of their 2019 baseline number by 2030. And as of 2022, they're already 40% to that. So this is, we really saw a lot of initiatives, one being the environmental, also the compensation model that Brian Nickel implemented when he came in as CEO. And this just really made us excited what they have implemented. And that's how we differ by having a more forward outlook on our ESG score.
Can you guys provide me some color regarding the return on invested capital and the WACC that you are using? So I would like to see the spread between the ROIC and the WACC in your perpetuity. And can you justify if that spread is too high? Because usually when you think any competitive advantage fades away throughout time, right? In 5, 7, 10 years. So I would like to see what's the spread between the ROIC and the WACC in your perpetuity. You guys have that?
Of course. So if we go back to slide 20, we have our return on invested capital here. this is historical, and from this point we see it continually to grow as margins expand, especially from sales leverage, and the sales growth also expands. So we definitely recognize that it's going to be a large difference from our weighted average cost capital, which is about 8.4%, which could be at risk if their competitive advantage does erode. However, what makes us confident in this spread is the fact that with Chipotle's improving ESG, it lowers the overall risk of the business model, especially compared to many of its other peers that we looked at. And as a result, we remain confident that Chipotle can not only sustain their competitive advantage, since they have a large lead over peers with regards to store count, being corporate owned, and having no debt on their balance sheet, as well as the improving ESG, which will make their overall operations more sustainable moving forward.
Could you talk about the Chipotlanes and how much impact do you expect that to have going forward? How many there could be, all those kind of things. It's a huge deal for McDonald's. It's a huge portion of their sales. That seems like it could be a key story here.
Yeah, I can start us off. Thank you for the question. So Chipotlanes are going to create significant value for Chipotle in the future. These Chipotlanes on average have 15% higher AUV than regular stores due to their increased digital throughput and their efficiency. And what I mean by efficiency is these Chipotlanes, you have to order through an app, and the average transaction time for a customer when they go to the drive-in window is about 30 seconds. Compared to that to your normal drive-through section, which is about 2.5 minutes, Chipotles are significantly more efficient. On top of that, and they're going to be expanding to these suburban areas where suburban areas have more driving, more family oriented, and efficiency is going to be the key here for Chipotlanes. And we see this as a critical way for them to expand in the domestic markets. And we see it to be very successful off of the recent research.
And maybe in terms of like your projections for just stores and margins, do those dovetail with management's projections? Are those, how do they compare to what management has said over the next couple of years?
Yeah, so specifically with our store count, our projections are largely in line with management. Our tangible addressable market shows the potential for 7,200 stores throughout North America. And this is very similar to management's 7,000. And the reason that we completed the tangible addressable market was to confirm those projections. And that made us confident in the large amount of white space that Chipotle has domestically. With regard to margins, we are more optimistic than management. However, we see this as justifiable just due to the fact that, as we kind of stated before, there's been large success in Chipotlanes in these larger suburban areas, as well as there's a significant amount of technological innovation that they still have to implement in many of their stores. On top of the fact that they have a really strong competitive advantage. And that's why we still believe that in addition to reaching their management expectations of their store count growth, that we can also see margins reach our forecast.
If your investment case is wrong, what will be the most important reason or the two most important reasons that you've missed building this buy case?
Yeah, I can start us off there. I think the biggest thing with our recommendation is we recognize there are a lot of risks with regards to the fact that we are forecasting them reaching their tangible addressable market, growing AUV substantially, and as well growing margins. And we think that the biggest area that we could potentially see some downside is with the same store sales growth. Since, as we said before, it's going to be extremely difficult, or it could be difficult for them to double store count on top of keeping that momentum of same store sales growth. And we've seen with peers such as McDonald's and Subway that large store expansion could be at the detriment of AUV. So that would be the biggest concern that we have and that we'd be looking for in the next couple of quarters and years for our forecast. And to kind of see the impact of that on our evaluation, again, we completed our sensitivity analysis where if they don't reach our AUV goals, but they're able to reach their store count goals, there's still margin of safety. And then in addition to that, we did the same thing with store count specifically. So if they're able to reach our same store sales growth goals, but our tangible or addressable market may be a little too optimistic. And even if they don't reach that tangible addressable market, we still see upside potential.
Thank you.
You mentioned your biggest downside, the same-store sales growth, right? How your margins compare to the streets margins, that is to consensus?
Yeah, so we definitely recognize that our margin expectations are going to be more optimistic than the streets. And the primary reason for this is for our calculations of sales leverage. So the way that we calculated our margin expansion is by looking at the sales leverage that it can attain from labor as well as occupancy. And we did this through a regression analysis, seeing the impact of a 1% same-store sales growth compared to the resulting change in these costs as a percent of overall sales. And that was the primary driver for our margin expansion. So by doing this, we wanted to make sure that we had our forecasts and had a foundation of data-driven forecasts. However, to account for the fact that these might be optimistic or this relationship may change over time, we did cap our restaurant margins at 29%. And as a result, our operation margins also capped at 18% by 2028, just to be as realistic as possible and to not be over optimistic with this sales leverage potential.
Would you mind addressing some of the challenges that restaurants face hiring staff in both quantity and quality?
Yeah, I would love to address that. During COVID, more specifically, we saw Chipotle and restaurant industry as a whole, their turnover increased dramatically.
Good afternoon. We are the Creighton University Research Challenge team. I'm Casey. That's Evan, Drew, and Maggie. We initiate coverage of Werner with a sale recommendation and target price of $38, which reflects a weighted average of our intrinsic and relative value estimates. Our target price of $38 represents an 18% downside from the current price of $46. Werner, with a market cap of $2.8 billion, currently trades at 11 times earnings. Werner shares currently yield 1.18%.
Our sale recommendation is premised on two main concerns. First, Werner operates in a competitive industry that is currently facing headwinds that include driver shortages and high fuel costs. These headwinds have led to Werner experiencing an erosion of over 150 basis points in operating and net profit margins last year. Second, Werner operates in a highly cyclical industry with many signs pointing to a recession this year. Continued high inflation, forecasted lower economic growth, and expected higher unemployment are signs of concern for Werner, given its relatively small market share of 3.4%. We begin with our first main concern, challenging industry dynamics in a competitive trucking industry and a softening freight market.
Werner is a transportation and logistics company that transports shipments of general commodities, most in the U.S. Werner operates more than 8,000 trucks and uses more than 24,000 trailers annually. Werner transports goods mostly from retailers and is dependent upon a fairly concentrated customer base. Werner's largest customer, Dollar General, accounted for 14% of its revenues last year, and its largest 50 customers accounted for 77% of its revenues. Since the majority of its hauls are for discount retailers, Werner has positioned itself to deliver volumes that tend to be less sensitive to economic conditions. Werner's revenue comes from two segments, TTS and logistics. About 80% of the company's revenue each year comes from the TTS segment. The TTS segment is divided into dedicated and one-way lines of service. The segment's revenue mix has tilted toward a dedicated line in recent years, now at 61%.
Over the past 5 years, total revenue grew from 2.5 to 3.3 billion, representing a 4-year CAGR of 7.2%. Operating margin trended upward during that time, topping out at 11.3% in 2021. However, Werner just reported an operating margin of 9.8% for last year, a sharp decline from 2021. Over that same time, earnings per share were fairly flat until a sharp increase in 2021, followed by a contraction last year. With the exception of a special dividend in 2019, dividends per share have increased steadily each year. Over the past 5 years, OCF grew steadily with the exception of a steep decline in 2021. Trucking is a capital-intensive industry, as evidenced by Werner spending well over half of its OCF each year on CapEx. Returns on assets have averaged around 10%, and returns on equity have ranged from 14 to 20%.
With respect to ESG, Werner has a satisfactory but quite low environmental score of 33, which indicates
that Werner is only in the 33rd percentile of all freight and logistics companies. Its social ranking in the 35th percentile is satisfactory, but also quite low. Werner's governance is viewed as good, being in the 71st percentile. Overall, Werner's ESG score of 45 implies higher than average ESG risk. Werner's board of directors consists of 9 members, all of which are independent from the company, with the exception of the CEO, Derek Leathers. However, we are concerned that over half the board has been replaced since 2020.
The trucking industry generates over $300 billion in revenue each year and transports about 73% of all freight in the US. Industry revenues have been flat over the past 3 years. The industry is highly competitive, with as many as 1.5 million trucking companies operating in the US. The 5 largest companies control about 62% of the market, with Werner being the 5th largest player. The intensity of rivalry and threat of new entrants in the trucking industry is high. Barriers to entry are low, as new entrants are only limited by their ability to finance the purchase of trucks and trailers. The bargaining power of buyers is moderate. The US trucking market is extremely fragmented, with companies fighting for market share, resulting in very little pricing power. The trucking industry faces a moderate threat of substitution. Most goods are transported by truck at some point during transport. The bargaining power of suppliers is moderate. There are only a few companies that produce trucks with the advanced safety features that the large players demand.
Taken together, competitive pricing, higher fuel costs, and higher driver wages have started to pierce margins in the company's operating ratio. Further, management has recently noted that the freight market is softening, with much fewer premium pricing opportunities available.
Our second concern relates to valuation in light of expectations of a recession this year. In 2021, the US economy bounced back from the COVID shutdown, but economic growth sputtered last year due to high inflation and the war in Ukraine. Economic growth is expected to remain fairly muted this year, with the Fed forecasting real GDP to grow by only 0.7%. The unemployment rate is projected to rise from 3.6 to 3.8% this year, as higher interest rates begin to curb consumer spending. In July, the 2-10 Treasury yield spread went negative and has been negative ever since. The negative spread has long been a predictor of a recession. The negative spread, currently hovering around 70 basis points, is at its most inverted level in 4 decades.
We value Werner shares using both an FCFF model and a relative valuation. We weight them equally to arrive at our target price of $38. In both valuations, we also build in a recession scenario to consider, given the Federal Reserve's 57% probability of a recession this year. We estimate the cost of equity using 3 approaches. Our estimates range from 11 to 12%. We use a cost of equity of 12%, which is equal to the BYPRP estimate plus a 25 basis point ESG risk premium. The cost of debt is estimated using the current rate on Werner's short-term variable bank debt plus a 50 basis point ESG risk premium. Using these assumptions, we arrive at our estimated WACC of 10.5%, consistent with management's estimates. We value Werner using an FCFF model under 2 scenarios, our baseline soft landing scenario and our recession scenario. Using a bottom-up approach to forecast revenue and margins at the segment level, our soft landing scenario assumes revenue growth of 7% and profit margins of 9%. Our recession scenario assumes a decline in revenues of 15% this year and profit margins of 6% before recovering to baseline revenue and profit margin assumptions in subsequent years.
Using our assumptions for the soft landing scenario, we estimate FCFF for the next 5 years. We then estimate a terminal value using our WACC of 10.5% and a terminal growth rate of 3%. We discount the cash flows and arrive at a firm value of $3.2 billion. After subtracting debt outstanding, we arrive at an intrinsic value of $40 per share. For our recession scenario, we again forecast FCFF for the next 5 years based on our recession assumptions. Under this scenario, we arrive at an intrinsic value of $34 per share.
We weight our recession and soft landing scenarios evenly to arrive at a final intrinsic value of $37. We also perform a Monte Carlo simulation around key assumptions in our baseline soft landing scenario. The 5,000 trial simulation yielded an average intrinsic value of $39. Further, value estimates of $46 or greater, Werner's current share price, only occur in about 22% of the trials.
We also value Werner shares on a relative basis, using multiples of Werner's peer group, in addition to its own historic multiples. We value Werner shares using peer group multiples, the company's own historic 5-year average multiples, and expected multiples under a recession scenario. We apply weights of 60, 10, and 30% to the PE, price to sales, and EV to EBITDA multiples, respectively. Using current multiples, we arrive at a value estimate of $40. The estimated value using historic multiples is $50. In our recession scenario, we assume a multiple contraction of 20%, which yields an estimate of $33. Applying weights of 25, 25, and 50% to the 3 scenarios yields a final relative value estimate of $39.
Werner is subject to a number of business risks. First, Werner is subject to regulatory risks in the form of safety standards as they are regulated by the Department of Transportation. Second, Werner operates in a cyclical industry. As noted previously, there are expectations of a recession this year, which has the potential to greatly impact Werner, as seen during the 2008 to 2009 financial crisis when its revenues declined by 25%. Third, Werner faces significant ESG risks given its low environmental and social scores. Finally, due to driver shortages and high
1 minute.
rates, employment and personnel is an operational risk for Werner.
In conclusion, our target price of $38 is an equally weighted average of our FCFF intrinsic value estimate of $37 and our relative value estimate of $39. We believe that Werner is a well-run company with strong management that has performed well in recent years. However, given the current challenging industry dynamics and the fairly high expectation of a recession this year, we believe that Werner is a classic value trap with no meaningful catalyst on the horizon. Thank you. At this time, we are open to any questions you may have.
Thank you, team. Time will start as soon as the first judge begins asking the first question. You will have 15 minutes for Q&A. Feel free to begin whenever you're ready.
Hi guys, let me start. I'm wondering about your terminal value. What is the long-term growth rate that you're assuming, and how does that dialogue, how does that talk with your the capex of your terminal value?
Yeah, so in our discount cash flow model, we assumed a terminal growth rate of 3%. And here are all of our assumptions here as well with CapEx. That's a normalized CapEx margin of 11%. We also ran sensitivity analyses with the Monte Carlo that changed all of these assumptions to kind of see how they played into the share price and kind of played off one another. And the terminal growth rate was one of those factors that we changed in the Monte Carlo simulation.
Okay, if you allow me, because it looks like your capex is very close to your depreciation rate, so I'm a bit concerned. Is the company investing enough to grow 2% per year forever?
Yeah, so Casey, would you mind going to the CapEx slide, the OCF and CapEx? So we kind of believe that the normalized CapEx expenditures are kind of on the outsides here. 2021 was a difficult year because Werner cited they didn't have enough trucks. They weren't producing enough chips, excuse me, to produce the trucks that were up to Werner's safety standards. So we think that the 350 number is closer to a normalized margin for CapEx in relation to OCF. So they are spending a lot on CapEx each year. So we think that that's a big CapEx spend rate, but that's just kind of the nature of the business in the trucking industry.
In addition to what Evan was saying, Werner does forecast that their CapEx expenditures for this year are going to be closer to 450 to 500 range, which further indicates that they are taking up a lot of their OCF.
How does your negative view on the stock compare with management's view and with the street's view?
Yeah, so right now, we don't believe that the full effect of the recession is being priced into the stock right now. Historically, as we know, the stock market's a little slow to relay bad news. So we think that the street and management is a little more optimistic just because it's not reflected in that price right now. But we believe the last recession, they lost a quarter of their revenues. And so we don't think that that's being accurately reflected in the share price of $46 right now. Because if you lose a quarter of your revenue, the share price is going to take a huge hit.
Okay.
In addition, if we look at a 5-year previous performance of Werner stock, we see that they have continually underperformed not only the S&P 500, but also their peers, which is ultimately why we believe that they are a value trap.
And there's one more point that I would like to add into this. If you go back to the TTS split of one-way and dedicated, when you look at one-way, that's one-off, one-time customers A to B. Once Werner brings that in there, it's done. And this right here is something that we believe is very susceptible to Werner's or one-way revenue.
Thinking about the company's long-term business model, in your opinion, what's the biggest threat to the company's existence?
So I think one of the larger sets that we have been considering is the potential of Werner being an acquisition client or contender. JB Hunt may be the most likely candidate with the largest industry market cap at just over 18 billion. So that long-term could maybe be something to consider, although we don't consider it very probable.
Yeah, and in this industry, driver turnover rate is always going to be huge. It's upwards of 90%. So regardless of kind of what the unemployment rate does, this industry is going to see a lot of driver turnover rate. And that's always kind of the biggest risk that Werner cites is it's going to be difficult to supplant that driver turnover year after year.
Can you describe your conviction level in your negative view on the stock? Is it an avoid recommendation or is it a short recommendation?
We believe, based on their past stock performance over the past 5 years, we believe that this is going to be a long-term conviction. As I mentioned earlier, they've consistently underperformed their peers. They compete in a very challenging industry. We don't see any change as at the moment that could somehow change our recommendation.
Yeah, so I would say this is a short candidate, just because at best, we believe if we put all the weight on a relative value of $50 and then also put all the weight on the soft landing approach, at best, this share price is fairly valued. So we do not see this going much higher at all.
Okay. Thank you.
Can you talk about how you came up with your recession forecast? You said you expected 15% downside in revenue and that they had 25% in a prior downturn. Can you talk about that and how much your margins to decline in that scenario?
Yes. So as we talked about previously, Werner's revenues did decline by nearly a quarter during the Great Financial Crisis, and its net margins declined to 3%. So we decided to take more of a conservative estimate in comparison, with revenues only declining by 15% and net profit margins at 6%. So we took a more conservative estimate, all things considered.
On your ESG analysis, I'm wondering how does the company compare to its peers, and where is the biggest upside for them in the ESG world?
Yes, that's a great question. I'll take that one. In the ESG comparison, they are the second lowest in their competitors of the 5 that we showed you earlier. If you can go to the Refinitiv score, Casey, real quick. So the upside with them is obviously their governance. They have really good management. And then if you click the next slide, Casey, you'll see that 89% of the board is independent and over half of it is diverse, which are hitting some of the marks that Refinitiv wants when it comes to having good management. And that's why their governance is so high. And that's the promising side of it.
And I'm wondering, do they have any regulatory threats?
Yes, as we've mentioned, Werner does compete in a very challenging industry. They face many regulatory threats because they not only have to adhere to the Department of Transportation, but they also have to adhere to regulations within states. California, for example, is known for recently passing regulations regarding CO2 emissions and things like around that nature, which Werner has to adhere to on an individual basis as well.
And how do they compare to the peers in terms of the threats? Are they more or less exposed to the peers?
When it comes to the emissions side of things, they rank dead last in their comparison. So with emissions, they're not doing a great job in comparison with the peers. And that's the area that's the most concerning. They only have 10 electric vehicles in their fleet, and they're all in California. So they're just trying to meet those regulations that Casey talked about earlier.
Because Werner has lower environmental and social scores, we accounted for this in our estimate of their cost of capital as well.
If we came back to this analysis 5 years from now, what would be the top reason or the top two reasons that you would have been dead wrong in your thesis?
Yeah, so like Maggie mentioned earlier, we think they could be an acquisition candidate. That's the biggest thing that we kind of played out in our minds is what would an acquisition look like? And so we did a little bit of research on kind of the smaller players getting acquired because there are 1.5 million trucking companies out there. And so this goes up to 250 million. We believe that Werner would get taken out at about 8 times EV to EBITDA, maybe about a 30% premium on a PE basis. But right now, with the current high interest rate environment and the volatility of the industry, these companies just aren't getting a lot of debt. So we don't think that acquisition is that big of a threat. Maybe about a 20% probability or so, but we did look at that to kind of see what an acquisition would look like and kind of what the potential terms could be. So that is one scenario.
Thank you.
And what valuation would that give you, your 8 times ish, or how much upside is there if they do indeed get taken out?
Yeah, so we believe at best it would be about a 45 to 50% premium, about $69 a share. But if we expected value weight that and we give that, let's say, a 25% probability and what it's currently trading at about $46, in order to justify a buy position, that gets you to about $52 or 13% upside. You'd have to put a lot of weight on the probability and just kind of be banking on that acquisition to get any sort of a favorable return.
Okay, and then you mentioned the trucks being a competitive, or that the supply of trucks, that there are only so many suppliers and that they don't have a lot of leverage to negotiate with them. On the technology side, the one thing I have heard of is the software that basically requires truck drivers to work only a certain number of hours and adhere to speed limits. Have they implemented that, and has that I'm assuming has already impacted them? But was that like outside technology, or did they do that themselves? Is there anything like that coming along that could be a technology risk?
Yes, so Werner's trucks, they have an average turnover rate of trucks of about 2.5 years, which is fairly quick when you compare that maybe to other industries. And so they do have the most up-to-date technology when it comes to those trucks. And so, they more or less rely on three major suppliers, which is either Freightliner, Packer, and Navistar. And those companies are constantly reinventing their technology, both to be in line with the needs of truck drivers, because they themselves would like the most up-to-date technology, but also being conscientious of regulation from the Department of Transportation, as well as states. And so that's certainly something that they have implemented into their model and have a very high turnover of.
What is the biggest upside for this stock?
Again, we think the biggest upside is being an acquisition. Other than that, it's a value trap. It's consistently underperformed its peers and the S&P as well. But the acquisition, it would be the biggest upside. Again, we think if we put all the weight in the best case scenarios from our valuations, we believe at best it is fairly valued. Maybe a 1% dividend you can add on top of that, but we just don't see a ton of upside outside of an acquisition. And yeah.
You mean being a target of an acquisition, being acquired, right?
Correct.
You guys see artificial intelligence changing the industry dynamics? Or self-driving vehicles?
Yeah, so they have, go ahead, Casey, I'm sorry.
So Werner has partnered with Kodiak, which is another
Time.
Okay, hello everybody. Discover why Grupo Energía Bogotá is an excellent choice to invest in Latin America energy future. With stable and growing dividends, higher margin than its peers, and an unshakable commitment to sustainability. With a target price of 2,386 Colombian pesos and a 53% growth potential. This statement is based on three main catalysts: the significant growth potential in Brazil, the elevated margins and stable growing cash flows, and being a paragon of exemplary ESG practices. Grupo Energía Bogotá is a leading business group that operates in the utilities industry. It has a broad portfolio of investments in associates, subsidiaries, and joint ventures, and presence in Colombia, Peru, Guatemala, and Brazil. Its corporate strategy is based on sustainability. The company recognizes global trends in the industry, playing a leading role in energy transition while creating huge value for the stakeholders. As part of the sustainability roadmap, they're aiming to double the EBITDA by 2030 by increasing renewable generation capacity, the transmission lines, and their share on the Peruvian home market. And a big part of this sustainability approach is held through the exemplary ESG practices. We believe vertical and horizontal integration are one of the company's biggest strengths, as they manage both the natural gas and the power market in all the value chain. Energy market in Latin America is highly regulated, developing a very stable market with regular income flow and demand. Grupo Energía Bogotá is committed to become a relevant player in Brazil. With its recent acquisition, they position themselves as the 5th largest private company by transmission lines in this big market. And this acquisition is held to take advantage of natural monopolies provided by the regulatory framework and responding to the solid financial structure that the group has. Another group strength is having a large market share in the business where they operate. They stand out for being the first or the second in each business.
We will now discuss some key financial metrics. Most operating income comes from the gas business via 60% share of EBITDA. As you can see, 50% of the company net income are dividends. The revenue growth over the last 10 years is better than the peers, with a value of 24%. Also, the free cash flow to sales ratio is highly superior, being 5 times higher than the peers. So the group is better in net and operating margins. We expect that this will be maintained thanks to operating stability provided by regulation. We expect the company CapEx to remain at maintenance levels after the large investments in Brazil. This capital will be used to renovate and repair the existing property. We also focus on the fact that, despite the higher debt, the holding has a very good performance. That's because it has the best sales indicators in each country, Colombia and Peru. This company is very famous in the terms of the return to investors. If you look to a ROE at the dividend yield, you will see that they are better by 1.5 times than the peers. We also expect that the dividends will continue to grow at this historical rate, which has been paid without interruption over the last years.
The company seeks to ensure that all its stakeholders, whether shareholders, employees, customers, or local communities, benefit sustainably from its operations. Grupo Energía Bogotá is committed to constructing new companies in the territories where it operates, and that these companies are low carbon and energy efficient. As main goal, the company has to reduce the greenhouse gas emissions by 51% in Colombia, 30% in Peru, and 42% in Brazil by 2030. Also, the issuance of green bonds is something that the company should get better to invest more in projects to help the company and the territories where it operates to become low on neutral carbon. Grupo Energía Bogotá also is pleased to say that they not receive any sanctions or fines related with environmental or climate change regulations in 2021. However, it is not just about their money. They have also put money in the communities where the holding operates. They have made investments of a whopping 4 billion Colombian pesos to help the communities to develop social programs. The company firmly believes that life comes first and has had no deaths or fatal accidents when employees were performing their duties. In terms of governance, the company is furthermore is proud to be above the median in this category. The board composition is diverse and independent, with a high audit qualification according to Bloomberg at 8.97 out of 10. Avoiding CEO duality and all the agency problems are two of the main characteristics of the structure of this board. To acknowledge also that District of Bogotá controls 65.7% of Grupo Energía Bogotá, which gives it the decision-making power. The board structure of the board of directors establishes that the agreement of at least 2/3 of the members is required to make certain decisions, which helps to protect the company from possible political decisions that could affect all the development in the company.
We issue a buy recommendation for Grupo Energía Bogotá with a target price that is supported by a throughout sum of the parts approach and reinforced by complementary models as relative valuation, a dividend discount model, and a Monte Carlo simulation. We consider the sum of the parts as the most accurate way to value Grupo Energía Bogotá since it works as a holding company. This process made possible to take into account all the different countries and markets where the company operates. We valued a total of 15 companies independently, and most of them were treated under a DCF model. This process incorporates the most important companies of the group, and the rest ones were treated under different methodologies due to insufficient financial information. However, they were analyzed without ignoring their importance within the group. We also applied a conglomerate discount to the aggregated equity value, since the company is highly diversified in different countries and sectors. The market perceives that a conglomerate structure creates complexity and inefficiency, making it really difficult for investors to understand and value the different businesses. This is the reason why they may be hesitant to invest in conglomerates, because they prefer investing in companies that are more focused on a single industry or market. This discount corresponds to the market capitalization as of April 3rd, 2023. This is how we found out that the electric utilities and the Colombian companies are the most representatives in evaluation. In addition, 30% of the equity value is originally denominated in dollars, but made its currency a sensitivity variable. For the calculation of a discount rate, WACC, we use the US market as a basis. We built a different beta for each industry by a rolling beta methodology that implies the industry peers and the US market over the last 5 years. This is how we obtain a different WACC for each business of the holding. Our first complementary model is a relative valuation. For this model, we segmented the company peers into 6 regional groups around the world. We consider a total of 868 peers that operates in the utilities industry, specifically in the power and natural gas sector. After a deep analysis, we decided to use the median of the 6 multiples for the Latin American peers. This is the region not only where the company operates, but also the resulting price wasn't overestimated as it was with the other regions with developed countries. This model supports a buy recommendation with a target price of 431 Colombian pesos. We also perform a two-stage dividend discount model to find intrinsic value of Grupo Energía Bogotá. First, we analyze the historical behavior of the dividends, finding a stabilization in 2016 with a 7-year CAGR of 11.6%. We use the forecasted inflation rate as a growth rate and the average cost of equity of the 15 companies valued as a discount rate. This model is really appropriate considering how stable the dividends are, and the two-stage modeling includes the growth potential in Brazil materialized after the recent acquisition. This model supports our buy recommendation with a 42% in the upside potential. And finally, we tested DCF variables with a Monte Carlo simulation. Those variables were the revenue growth scenario, the perpetual growth rate, the dollar exchange rate, the risk premium, and the risk-free rate. 74% of our scenarios supports our buy recommendation.
We perform our scenario analysis where we change some of the most critical variables in our DCF model. We consider some of the most important political and economical scenarios for this analysis.
As we've stated before, company operation is highly regulated. That's why they need to have close communication with local communities and the national regulator in order to gain approval and develop new projects. Also, the most important risk at the moment is the political and the country risk. We strongly believe that the market has already incorporated this aspect.
1 minute.
Since company operation, government contribution to low-income population energy consumption, and the regulatory component are critical to the group's financial health. All that being said, we restate our buy recommendation for Grupo Energía Bogotá, aiming at a target price of 2,386 Colombian pesos. Thank you so much for listening, and now we will take your questions.
Thank you. All right, please stay muted unless you are speaking. I will start time as soon as the judge begins the first question. Time will end at 15 minutes. Feel free to begin whenever you're ready, judges.
Could you talk about how you tried to quantify the political and regulatory risks that you've identified?
I can take that question. Okay, so the political risk is, as we stated in the presentation, is probably one of the most important for this company. Why? Because investors are seeing the Colombian companies as risky for the new government and all the policies that are going on right now in the country. So that variable was included in the calculation of our WACC. The discount rate includes the country risk premium for the Colombia and Peru. Those three countries are the ones that the companies that we evaluated by a DCF model and operate in those countries, right? And these rates that you're seeing right now is the perpetuity rate. Why? Because right now the country risk premium is a little bit higher than this, but in perpetuity we expect that it's going to stabilize and the country risk premium is going down. And when like the situation and the expectation of the investors and will stabilize with time, basically in the short term.
Thank you.
You guys mentioned about perpetuity. I'm wondering the following. Usually this kind of assets, they are like concessions, which the asset has to be given back to the agency, to the country. So you're perpetuating all assets or some assets?
I can take that one. Well, actually, for example, in Colombia, the concessions are made they're often operated by the company in perpetuity. And most of the assets, they are operated by the company in perpetuity. So they have the commitment to make the investment and build the infrastructure and then operate it. So this, for example, when they earn a concession, when they win the concession, they establish themselves as the natural monopolies in that line of frequency between those two cities. So they receive a really forecastable or predictable free cash flow, well, actually income from that line. So they are mostly long lifetime operated.
Do you have a sense of what's going to happen to your DCF value if the concession is not renewed? If the concessions are not renewed?
I can take that one. And in terms of that, we analyze the situation of every single company. And we find, for example, that TGI, one of the biggest subsidiaries that is controlling the gas transportation in Colombia, we foresee that the lifespan of the contracts are going slower in the lifetime. So that was included in the valuation. We analyzed every single company and what were the lifespan of the contracts. If we look at the TGI free cash flow development, we don't have like the whole forecast period, but we foresee that the free cash flow is going down because of the lifespan of the contracts are reducing, okay? So for other companies, we analyze that they're not going to, in the short term, at least in the 10 years that we projected, and they're not going to like to stop or to finish the concession that they have.
Can you talk more about Brazil? You talked about it as being significant growth potential, but can you give some more details behind what the strategy is there and why they are able to grow there?
Of course, that's a really important question. Daniel, please take me to Brazil expansion. So what they are doing in Brazil is they are acquiring 5 commercial operating assets. So their investment is made and it's immediately gaining revenue. They're acquiring around 2,400 kilometers of transmission lines in the north of the country. Why it's the north a key point for this investment? Well, Brazil is looking for an energy transition scheme in which renewable energy will be located mostly in the north of the country, where there's not big cities and not too much population, so they can make like those investments in solar, wind, and that kind of renewable energy. And Grupo Energía Bogotá looked at the transmission lines as a key point to connect those faraway renewable energy points to the center of the country and the big cities. So they say that there is no energy transition without transmission. That is the main reason they acquired those operating assets in Brazil.
Also, I would like to add some information there, is the fact that if we look at the LATAM energy profile, we can see that in terms of generation, Brazil is in the top in terms of energy generation. But in terms of the development of the transmission lines, of the transmission system, it's not that developed. So the company found, let's say, an opportunity to invest in that country. And right now the expansion plan is planning to basically consolidate the system and to become a relevant player in that market. And that's why it's one of the catalysts of our investments.
And on your evaluation, also, can you discuss why you chose your sum of the parts rather than, say, a DDM, which might be a little more conventional choice?
Okay, in terms of the valuation, like our first model, like the one that you sell at the target price of 2,386 is the sum of the parts. I'm going to show you the equity value breakdown. We valued every single company. 10 of the 15 companies were valued under a DCF model. And DCF model is like is conventionally the best methodology to value this kind of companies. But the DDM model and the relative valuation are complementary models to find how is the company being priced in terms of the dividends or in terms of relative or their peers in Latin America or in the world, because we consider a lot of peers around the world. But the valuation of the sum of the parts, we consider the most accurately, because also we consider some discounts that include those factors that are affecting the company or the investors are seeing in this company. So if you would like to go deeper on that, we could do it.
And in addition to that, we think that the sum of the parts approach is better because we had to analyze each company and forecast the free cash flow of each company. So we are not making mistakes in taking the whole company as a one, because each company has a different situation and a different country. So we calculated a different WACC for each company that represents better the situation of the companies.
Right, and you talked about having a conglomerate discount, which looks like it's 32%, which seems appropriate. Sorry, I just forgot my question. Never mind.
Okay.
Guys, in slide 10, you have the profitability measures. You have the company has a higher ROE, ROA, and lower return on invested capital than its peers. And why is that?
Okay, if we analyze the peer comparison, we can see that compared to peers, like in this presentation, this slide, we can see the comparison of some of the most important ratios or indicators, financial indicators for this company. We can see that the net margin, the EBITDA margin, and the dividend yield are higher than the peers. But if we analyze that, it's because operative speaking, the company is really strong. And the subsidiaries that are part of the conglomerate are really good. And also, they're really diversified in different sectors. So they're not exposed to the risk that may present the natural gas separately with energy. Okay, so if we analyze and the companies outperforming its peers in most of the indicators, especially in those who are really important for investors, as the dividend yield for the Colombian peers, for example, and the EBITDA margin and the net margin are really high, because also it's important to consider that the company received a lot of dividends from the subsidiaries.
Okay, I would like to add that the return on invested capital is that low because the company has, in the recent years, making some big capital investments in Brazil. So this is one of the reasons that we expect that the return on invested capital is lower than the peers, because no other companies in the region has made such a big investments like the company has.
I got a sense that the company's net debt to EBITDA is high. So I'd like to get your view on that, especially in this environment of high interest rates.
Okay, I can take that one. The company's debt is really high compared to the EBITDA because the company has a lot of income coming from their subsidiaries. So when you make the calculation of the EBITDA, the dividends that they receive are lower in the calculation. So a good way to look at this is showing the net debt to EBITDA as the first measure. And you can also look that the dividends have been growing all the time. So the company is kind of over-indebted, but the revenues are also growing with the debt. So there is like no risk that the company will go bankrupt or something like that. And they are still paying out the dividends with a lot of consistency in the time.
And also, I would like to jump on that and say something about the high interest rate that you were mentioning in the question. And we will consider that in our valuation in terms of the calculation of the WACC. The discount rate includes the high interest rate, but in the perpetuity, we expect that to stabilize. So in terms of like the most important part of the valuation is the perpetuity, as we were talking previously. But that factor of interest rate is really high, and that is being reflected in the price of the company. If we look at the stock price behavior, we can see that in the last year, the stock price has dropped at 37%. And this is not only about the economic downturn that is happening right now, but also is because what I was saying, the investors are seeing this company as risky. This is something that is happening to all of the companies listed in the Colombian stock exchange and most of the Latin American countries. So that was included in the valuation, also in the discount that we were doing in the valuation, in our main valuation with the sum of the parts approach.
I also want to acknowledge something there. Most of the debt of the company is in fixed rates. So it's important also to mention that the company protects himself from all these risky situations that are going on right now.
So you're building a bull case for a 50% plus upside. What is consensus missing that you see for such a high upside on an immediate basis?
Okay, that's a really good question. And I'm going back to the stock price behavior in terms of what is like why investors or the market is misvaluating the company. We have some drivers to start it out. First one is the one that we mentioned before, the economic situation that we're living right now. But we also would like to focus on the fact that in Colombia and some Latin American countries, there are problems of liquidity. The Colombian stock exchange is like the liquidity is really low. And also it's important to consider that most of the company is owned by the Colombian government, which in not only reduce the liquidity of the shares that are standing in the market, but also is making from the perspective of risky, the new government that is going on, some capitals are going out of the country. So right now we are in a volatile moment. So the price is being affected by that. But we expect in the short term the company will return to the price that it had. And we can see here that it was in level 2,607.
Thank you.
Also, I want to say something there that in this scenario around the world, in high interest rates, the investors are going with for instruments that are more fixed, that have more fixed rate, like for example bonds or something like that, that are lower in risk, like stocks.
I would like to complement there, if I may. Diner mentioned that the government has a big participation in this company. It's like around 65%. Even though the government has that participation, let's take into the government contributions. The government subsidizes a big part of the energy consumption in low-income population, for example, in Colombia. Here in this graph, you can see that for the first and the lowest income population in Colombia, the government subsidizes up to 60% of the energy consumption. So we can actually kind of see that government is risky, but also it's a big client that you have. So you have like a stable and regular and sure income flow going to your vault every month and every year.
And guys, did you forecast the internal rate of return of the company's acquisitions they made recently to see if they were value accretive?
Okay, in terms of the new acquisition, that was a really important part of the valuation. But in terms of that, as they are really recent, like the recent acquisition in Brazil was made in November. We still do not have enough information to calculate those factors. But in terms of the valuation,
Good afternoon. We are the team from UT Chattanooga, and we will be initiating coverage on HCA by issuing a buy recommendation, reaching a 12-month target price of $325.17, which represents a 20% upside. Our buy recommendation is supported by management strategies to grow patient volume. These strategies are geographic positioning in key locations, investments into the continuum of care, a calculated focus on scale, and strategic financing of growth. These strategies will help HCA to grow their competitive advantage over peers in the medical facilities industry. HCA is a healthcare services company that is currently headquartered in Nashville, Tennessee. HCA operates more locations than their competitors near their key demographics in Texas and Florida to continue to take advantage of the aging populations and migration trends in these markets. This is evident by the graphs, which show they are operating markets with the highest proportions of aging populations and year-on-year population growth.
Growth and volume is vital for HCA because healthcare service companies lack pricing power, requiring continual investments into scale to maintain profitability. The table shows HCA has wisely focused almost all of their growth in the key market of outpatient care. Not only is the demand for outpatient care growing, this revenue segment has other advantages as well. The revenue breakdown shows HCA's outpatient care is less reliant on government reimbursement and favors a higher margin patient. Additionally, HCA's outpatient facilities help to form a core satellite network that is in close proximity to their inpatient centers, which forms a continuum of care network. The appropriate operational metric at which to gauge HCA is equivalent admissions. Equivalent admissions is a general measure of inpatient and outpatient volume. Over this 5-year period, HCA far outpaced its for-profit competitors. Trends in healthcare services overall favor less expensive, less invasive outpatient alternatives. HCA's aggressive expansion of outpatient capacity, especially in key geographic locations, has allowed HCA to continue to gain market share. This strategic focus on volume and scale improvements has created a healthcare network well positioned to capture this major shift in patient demand.
As previously mentioned, volume is vital because regulations control the maximum price that HCA can charge for care. With these price controls in mind, HCA has focused on growing volume by increasing scale in key markets. As is evident from the map, HCA has a far greater presence in Florida and Texas than all of its for-profit competitors combined. Thus, HCA has positioned itself favorably to capitalize on migration trends as well as the aging U.S. population.
In addition to more hospitals, HCA also operates larger hospitals than their competitors. Both of these scale advantages allow HCA to spread their fixed costs over more revenue-generating operations. One example of these increased efficiencies is seen in HCA's growth in net income per licensed bed, especially compared to their peers. Likewise, HCA has seen similar upwards trends in their operating profit margin. Thus, scale has worked in HCA's favor, and management has clearly stated their plans to continue to grow scale going forward.
2015 through 2019, HCA grew its revenue by 6.65% annually, which was the highest rate amongst its peer group. Nearly 60% of this revenue growth was directly attributable to their 3.95% annual growth in volume, while the rest is attributable to their 2.6% annual growth in price. Prior to the pandemic, HCA's prices grew in line with medical inflation. During the pandemic, HCA's prices grew at a rate which greatly outpaced medical inflation due to higher Medicare reimbursement rates and a higher overall level of patient acuity associated with the virus. We believe the price growth rates seen during COVID-19 are unsustainable. Going forwards, HCA must grow its revenue by growing its volume, which it will accomplish through its favorable geographic positioning and by capturing the continuum of care. HCA has $38.1 billion of outstanding debt obligations, with $4.5 and $5.1 billion coming due in 2025 and 2026, respectively. The majority of this debt is also fixed rate, meaning that HCA will be less sensitive to interest rate hikes in the near term. Management is unconcerned with these debt obligations due to a declining trend in the debt to adjusted EBITDA ratio, showing that earnings growth has outpaced debt growth over time. Management has also historically managed interest rate risk well, shown by a declining trend in effective interest rate. Additionally, HCA saw its credit rating upgraded from BB+ to BBB- during 2022. This credit upgrade allowed HCA to increase its average life of debt from 8.9 to 9.6 years and should allow it to keep its effective interest rate low despite the rising rate environment. The DuPont analysis reveals that HCA has grown its profit margin and maintained a strong total asset turnover ratio, leading to a growing return on assets over time. However, it also shows a return on equity which fluctuates heavily from year to year due to HCA's highly leveraged capital structure. In fact, from 2011 through 2019 and again in 2022, HCA had a negative leverage ratio due to a negative shareholders' equity balance. This negative equity was the result of HCA's 2006 leverage buyout, as well as its aggressive share buyback program, both of which have gone against the company's retained earnings. Because of HCA's highly leveraged capital structure, we believe it is more useful to analyze HCA's ROA versus its competition. In 2022, HCA was the most profitable and most efficient with its assets, leading to it generating an ROA which was 5.75 percentage points higher than its next closest competitor. This favorable ROA versus competition is the result of HCA being successful in all four of the management strategies outlined previously.
HCA has been able to attain a higher environmental score than their peers. This has mainly been due to management's focus on sustainable sourcing and product usage, which has been spearheaded by their Sustainability Steering Committee. HCA also has a long history of philanthropy, with their largest philanthropic fund being their Healthier Tomorrow Fund, which supports communities in need around HCA's geographic footprint. They also have a strong emphasis on patient data protection, having a far above average score on protection and privacy. They do have a score below the industry average in labor management. This poses a risk to their ability to attract and retain staff, which will be discussed in our risk section. HCA is currently governed by a diverse group of highly qualified individuals with strong credentials and industry experience. Their board of directors has also been able to maintain a majority independence that is in line with the rest of their public peers. Thus, HCA has recently received a ratings upgrade from A to AA in their ESG score given by MSCI.
Labor is one of hospitals' largest expense. Currently, 55% of nurses in practice are 50 years or older. This situation could increase replacement risk if nurses leave the field faster than new nurses can replace them. Regulation could further pressure margins. We expect reductions to inpatient care reimbursement going forward. This should be offset somewhat by HCA's expansion of outpatient capacity. HCA could also be exposed to a higher population of uninsured, as their prevalent states have a higher uninsured rate compared to that of the greater United States. An economic downturn could also exacerbate the rate of uninsured peoples, leading to an increase in services rendered to uninsured patients. Although we have discussed our belief in HCA's strategic financing of debt, a credit downgrade could limit HCA's ability to finance future growth and scale. This, as well as our labor concern, will be addressed in our valuation.
We ran an EV to EBITDA, but did not include it in our valuation because HCA has a vastly different capital structure compared to its peers. HCA is much more leveraged than all its competitors, which skews its leverage ratios and materially impacts its EV to EBITDA multiple. We believe this metric does not show an accurate representation of HCA's value compared to its peers. Furthermore, HCA has a far superior operating profit margin as well as better revenue per full-time employees than its peers. Thus, although we use a discounted cash flow model to value HCA, we do think these relative metrics add support to our overall buy recommendation. As for our DCF model, we first forecasted revenues through equivalent emissions growth guided by company guidance and historical year-over-year growth. An assumption also is applied that there will be a small permanent increase in these numbers due to COVID-19. We then multiplied these projections by revenue per equivalent emissions and got to get total projected revenues. For a bear case scenario, we adjusted equivalent emissions growth to 1.5% year over year based on a 15% possibility that HCA faces significant labor shortages and struggles to finance its debt. The latter assumption would limit HCA's ability to grow through acquisitions, severely reducing its ability to add scale and capture equivalent emissions growth. To reflect this risk, we increased HCA's pre-tax cost of debt by 200 basis points to reflect a higher WACC. Our bull case also assumed a 15% possibility that equivalent emissions growth reaches 7% year over year based on two assumptions. First, that our projected increase in equivalent emissions due to COVID-19 was originally too conservative. And secondly, that interest rates return to favorable levels and allow HCA to expand at an even greater pace. We then calculated HCA's cost of equity using CAPM, and for its cost of debt, we used the current interest rate on BBB minus bonds and applied HCA's effective tax rate. From here, we arrived at a base case WACC of 9.59%. For our growth rates, we used an interim growth rate of 7% that was based on historical revenue growth and a terminal growth rate of 3.5% based on annual US GDP growth, coupled with the HCA's presence in high growth markets. With these assumptions and weightings, we derived a one-year target price of $325.17, representing an upside of 20%. We also used a Monte Carlo analysis as a stress test for the same variables that we considered for our bear and bull case scenarios. As the graph shows, this analysis offers additional support for the price ranges provided by our bear and bull cases.
We then ran a sensitivity analysis on our base case target price. We adjusted our assumptions 50 basis points to our WACC and terminal growth rate. 78% of the scenarios are above the current price as of April 10th.
Once again, we reinforce our buy recommendation as supported by our investment thesis points discussed throughout the presentation and are confident in our buy recommendation at a one-year target price of $325.17. Thank you.
Thank you, team. Judges, we will begin Q&A now. Again, everyone, please stay muted unless you're speaking. I will start time as soon as the first judge begins asking the first question. Time will end precisely at 15 minutes. Feel free to begin, judges.
Guys, let me shoot the first question here. On a DCF analysis, you see some upside, but on a relative basis, on the multiple analysis, the company looks expensive. How do you deal with that?
Correct. So as previously mentioned, HCA has a different capital structure than its peers. It's more leveraged than its peers, which throws off its EV to EBITDA multiples. However, HCA has also had this same premium multiple historically for the past 5 years.
Okay, what I'm concerned here, when I see your slide 66, where it says CapEx divided by assets, HCA has a much higher CapEx per asset, and that's what concerns me, because the company has to invest a lot to grow. Does that make sense? Is that correct?
Correct.
HCA has utilized this high CapEx spending versus their assets to fund their expansion into outpatient, which has allowed them to capitalize greater scale versus their peers, which has benefited them, increasing their margins and increasing their volumes relative to their peer group.
HCA's focus on their CapEx has shifted from M&A to focus on CapEx to further diversify their healthcare network. This allows them to capture the continuum of care and capture a patient at any level of acuity.
Could you talk about the credit rating history, please? HCA has had some ups and downs with the credit rating agencies in the past. Could you tell me why it's possible in your bull case that you think there could be another increase on the horizon?
So our bear case does assume that HCA could potentially experience another credit downgrade. However, our bull case does not assume a further credit upgrade, but rather that HCA retains their current credit rating and interest rates fall to favorable levels.
Okay. Thank you. Just to follow up on that, looking at the equivalent patient growth skewing toward the outpatient side, why have they been able to be successful in that regard in terms of equivalent admissions, more so than Tenet or community health?
HCA's focus on scale, especially in the Southeast, has allowed them to capture the continuum of care. So if a patient goes to one of their hospitals, they will be at every single level. And so this focus on scale and focus on capturing a higher margin patient has allowed them to have a diverse healthcare network, which is why they are doing it better than their peers.
Okay.
Tenet, as well as their other competitors, strictly focus on one specific type of outpatient center, where HCA does it all.
Okay.
Maybe talk about that then on the outpatient centers, you had listed kind of 3 types of care that they were in. What's the most attractive, and are they focusing on that more going forward? And then I want to talk a little bit about just growth of facilities going forward as well.
HCA focuses primarily on expanding their healthcare network as a whole to be a healthcare network and to capture that whatever level acuity of patient. So whether they need to go to an inpatient center or go to a recovery center, HCA has a position in that market. Their goal is to capture scale and their geographic positioning in the Southeast. And that creates the ability to capture the continuum of care. And their focus on inpatient is particularly driven because it captures a higher margin patient, as seen in the revenue breakdown.
And so what's their, like, maybe a CAGR of facility growth looking back a few years and looking forward a few years? What's that look like?
I mean, particularly HCA has focused not on expanding their inpatient hospitals, as seen by this chart. From 2018 to 2022, they sold some hospitals, specifically in Georgia and Louisiana, which was not an attractive market for them, and expanded their outpatient care because they understand that not only is reimbursement going to favor an outpatient patient, but they can benefit from managed care patients as well that are higher margin.
Guys,
so going forward, do they have any numbers they've given for, say, expansion of outpatient, and are most of those kind of co-located with an inpatient center?
Nick, if you could pull up, that's perfect. So HCA's strategy is to have a core satellite network. So you're supporting your current hospitals with outpatient facilities. In the past year, they acquired the largest outpatient center in Florida to further their position in their Southeastern market, the markets that are most attractive to them. In terms of guidance, they're focusing on CapEx more so than M&A to expand their outpatient facilities.
Guys, what are the main triggers for the stock?
Main triggers for the stock would, excuse me, when you break it down, it's going to be your equivalent emissions growth. They have very limited pricing power over their services and their care, so they focus exclusively on their growth. So as far as their stock price going up and down, if they maintain this growth rate, their stock price goes up. If they were to potentially receive a credit downgrade and or be hit with labor shortages, then they would lose that growth and their stock price would in fact go down.
And it goes back to scale again. It's all about capturing volume, and patient volume is how they drive their business.
Is there any
maybe talk
competitor
about some
that
of
is?
the issues.
Go ahead.
Oh, sorry, then I was going to ask about some of the issues they've had with labor, like if that looks like a increasing risk going forward, or are they seen as being a good employer?
So currently HCA pays their employees about 20% more than their publicly traded competitors. And they also have a patient safety and quality of care committee, which would end up kind of helping with those labor management issues by making them work less hours to better their care for their patients.
Not only this, HCA understood during COVID when they relied on contract labor and slowly reduced that number, that labor was an issue they needed to fix. So they've done this by acquiring 7 new Galen College of Nursing, which are colleges that they are a majority owner of. So they have a pipeline of new nurses coming into their hospitals. And not only this, over half of their hospitals are training hospitals. So those nurses are coming into residency wherever they would like to. So they have flexibility within post-graduation from the Galen College of Nursing.
What are the main threats to your stock all?
Once again, as we discussed a little bit earlier, our main threats to the risk or the main threats to our stock are going to be their labor shortages and regulations. If regulations pick up, that will adversely affect them, as well as labor shortages being more of a deal than they are right now. However, HCA will be able to mitigate those risks better because they have a higher scale than the rest of their publicly traded peers and the rest of their nonprofit peers as well.
Right, these factors are headwinds in the industry, and HCA is the best in their peer group, and we believe that. And we believe that any sort of industry risks they will be able to better mitigate than their peers.
Have they talked about going into other markets, for example, California or some of the other Southeastern markets?
So they did actually recently try to acquire a chain of hospitals in Utah. It was actually the largest hospital chain in Utah. They were unsuccessful as of now with that because they ran into an antitrust lawsuit. But I would assume once that passes, they would try to once again move into that market. So they are trying to expand westward, yes.
So this also looks at where the highest aging populations and the highest migration trends are. So you'll see in 2018, they acquired 7 hospitals in North Carolina, whereas North Carolina has both a high proportion of population age 65 plus, as well as a higher than average year-on-year population.
See. What is your evaluation of management?
So their management has currently been successful in implementing the strategies that we outlined as their investment strategies. They also have been they've been moving people up in the company to executive teams so that it has more of a turnover instead of keeping everybody there for a long period of time.
Are these lifelong managers here at this company, or do they bring in people from the outside?
They have brought in people from the outside, both for their executive team and their board of directors. And their managers that have been with the company were heads of the company and then moved into a position similar within the executive team. And they've all been there. I think the longest person that's been there has been there since 2014 or 2009.
Sure. Thank you.
Of course.
Thinking long term, what is the biggest threat for the company's business model for its success? I mean, I mentioned the risks before, but I mean, apart from that, do you see anything else coming that might cause the stock to slide?
If HCA is unable to maintain volume growth, that is one thing that could cause their stock to slide. However, HCA understands that. They understand that volume is the hospital business. And that's why they've focused on capturing scale in the continuum of care. So long term, we believe HCA's management understands the long-term risks and are addressing them currently.
How do your forecasts compare to the street, to consensus?
We did not look too heavily into other analysts, as we believe more heavily in our own analysis that we did. However, I do know that a number of analysts have HCA as a buy as well. But again, we put more stock and more faith in the research that we did and the bare base and bull cases that we were able to come up with, along with the investment thesis points to back them up.
And using historical growth metrics for our valuation.
Could you address, please, their debt paydown intentions versus their CapEx rates? Thank you.
So HCA's current debt maturity schedule looks like this, with a large portion of their debt coming due in 2025 and 2026. Historically, HCA has spent about as much on repaying debt as they have on CapEx. We do not believe that in 2025 and 2026, these debt maturities will end up being an issue.
They also are very active in a massive share buyback program pretty much consistently. And we believe, it is our belief that when these debt maturities come due in 25 and 26, that they will slow down this rate of share buybacks in order to also fund these debt payoffs.
Okay. Thank you.
Can you talk some about the regulatory risk in terms of reimbursement challenges and how that's playing out in the industry, what's happened in the past and what could be expected going forward?
Right. Historically, we believe that inpatient care is going out. And if regulation was to hit the hospital medical care industries, it would be particularly in inpatient. The government has favored outpatient care because...
Thank you. And I want to start by congratulating all the teams for your remarkable performances today. You've listened and learned from your academic advisors and mentors. You've applied in-depth investment analysis. You've worked as a team, crafted excellent analysis reports, and your presentations were truly impressive. Every participant today is a winner, and I recommend that you use this experience in future job applications and interviews. Your participation in the Research Challenge has just made you even more interesting to employers. Don't waste that advantage. This experience should also give you great confidence in approaching the CFA program as a next step, and that is certainly something that employers are looking for. You've already successfully applied knowledge that is featured in the CFA program. You're in a perfect position to use this excellent start and accelerate your careers as CFA program candidates and future charter holders. By the way, you'll be amazed just how many successful members of ours were former Research Challenge participants. There's a long history to this. You started the journey so well, and career success awaits you too. I want to sincerely thank university faculty, the individual CFA societies, and our esteemed judging panel. You've all volunteered so much time and effort to make the competition the success it is. I know that you do this from a commitment to encouraging the next generation of skilled, knowledgeable, and ethical investment professionals. As you see today, your commitment has been incredibly worthwhile. So, no more from me. The results are in, and it's time to announce the finalists who will represent this region in the global final in Washington, DC. The winners are California Polytechnic State University, and California State University at Fullerton. So it's a California finish in the Americas region. Congratulations and well done.
All right, thank you again to all of the teams that presented today, our judging panel, and all of the volunteers. And a special congratulations to the 2 California teams that are advancing to the global final. I will be sending you an email momentarily with some information on the next round. Thank you.